Today we're going to be talking about why I hate home equity lines of credit and why I love home equity lines of credit. That's coming up next. What's happening, subscribers and any new visitors? Welcome to our channel. My name is Matthew Pillmore. I'm the president of VIP Financial Education, and we coach people the art of strategic banking and proactive borrowing. This is where we actually implement things we never learned in school. Now, we get asked all the time as a result of our education regarding tools that we call debt weapons, what we think about various types. One in particular that we hear of all the time is home equity lines of credit. Now, home equity lines of credit are secured against your home. These are collateralized based on the perceived equity position of your existing properties. Home equity lines of credit come into the conversation often. Why is that? Well, there's a lot of people talking about various types of acceleration strategies, specifically mortgage acceleration, utilizing a home equity line of credit. In most cases, this is done through a refinance into a first lien home equity line of credit. Similar concept to our paycheck and rent check parking. So why is it then, if we teach how to accelerate both mortgage and non-mortgage related debts, that I have reasons to hate home equity lines of credit? Well, it's really pretty simple. While there are a lot of upsides to HELOCs, which we'll get into later, home equity lines of credit are one of the most dangerous to rely on when it comes to replacing the inadequacies of your checking and savings accounts. There are accounts known as money merge accounts, which will refinance first lien mortgages into new first lien HELOCs, where you basically have your first lien mortgage paid in full and you replace it with a home equity line of credit instead. The downside to that is this. Number one, home equity lines of credit are attached to prime, meaning that the interest rates are constantly varying and can skyrocket. If you think back or look into the history of interest rates, you'll see that rates can go as high as almost 20% historically. So you certainly would not want to have a large first lien fixed mortgage refinanced into a varying interest rate that you could get stuck behind if the economy changes, which you can't control. The second reason I hate home equity lines of credit is when the economy fluctuates. You see a lot of reaction from lending institutions like the banks. You may recall in the last recession, the banks responded with a rapid tightening or constriction of their liquidity, where they made it much more difficult to get out and get access to funds. The other response that they had before almost anything else was to turn around and freeze home equity lines of credit. Now, it wasn't universal across the board if you had one, it was closed, but I will say that of the 3 HELOCs I had during the last economic downturn, all 3 were frozen. Not one of my unsecured debt weapon accounts were frozen. Now, why might that be? If this is collateralized, wouldn't the bank be in a better position than my unsecured accounts? Arguably, yes, but logically, if you think about it, it makes sense. They are seeing an asset that's going down in value that they lent against, securing their repayment potential against this collateral, and all of a sudden, it's not worth what it originally was when they lent you the money. So rightfully, you should expect that to be taken away from you. And that's exactly what happens. Home equity lines of credit finally can also be very difficult to get against non-owner occupied properties, against investment homes. That's why we strategize our repayment plan very specifically in order to target the right debts correctly in the right order, because we can then access that equity again very quickly and replace any of the cash flow we otherwise would have wanted access to, but instead we used it to pay off debt. So we don't just use money and pay off debt. We replace the money we're going to use with debt weapon accounts, and then we pay off debt in order to remain as liquid or even exponentially more liquid than we were before we started the process. So very, very controlled plan. If you don't have a very controlled plan in place for your current finances, strategies like this are incredibly important and valuable to you and don't require a significant amount of time. So that's a 71% improvement to his monthly results without any changes to his earnings or his lifestyle. Now let's talk quickly about why I love home equity lines of credit. First and foremost, they are 100% liquid. It's same as cash. If you've used a home equity line of credit in the past, you know you can simply write a check. It's money in the bank. You can get it, put it back, get it, put it back as many times as you want to. Another reason that I love them is they are often considered eligible forms of down payment. So if I want to go out and buy real estate, I can use availability from a home equity line of credit in order to do that. So let's say, for instance, I have a $50,000 home equity line of credit availability, and I want to buy a $200,000 investment property. And let's say I need 20% down for that to happen. I could borrow $40,000 from the $50,000 I have available, leaving $10,000 for vacancies and fix-up costs or general maintenance of that property, and I have now no money out of my own pocket in order to acquire a new asset. That produces, in both the short and long-term rental game, an infinite return on investment. That is really, really powerful. But now let's say a second property for $200,000 appears. I don't have another $40,000 available. Well, what happens if we were able to transfer that money away to another form of a debt weapon? That home equity line of credit would be available for use once again. Really, really powerful. Another reason I love home equity lines of credit is that under today's current economic climate, there are really low interest rates associated. When coupling that with techniques like paycheck and rent check parking, we can avoid substantial amounts of long-term interest costs on these tools. So they're very inexpensive. In fact, even getting a home equity line of credit can be relatively inexpensive compared to things like cash out refinances. When you go and you refinance a property and you take a home equity loan, which is an amortized product, versus a home equity line of credit, which is a revolving product, it costs substantially more money to get those. So if you can get a HELOC and spend hundreds of dollars versus refinancing and spending thousands of dollars, that obviously is really appealing. There are also potential tax benefits by using home equity lines of credit. That is just a cherry on the top. And finally, you can often get high loan to values with these primary residence home equity lines of credit. High loan to values can even exceed 80% combined between your first and potentially your second lien home equity line of credit. The other reason that's good is because in high loan to value markets, that often means you can get access to quite a bit of money. So the best case scenario and the conclusion of this video is that having a combination of all types of debt weapons and having a wide collection of each type is really important in order to accelerate the financial priorities that you and your family have. We want to be able to use each tool in its appropriate setting, but also simultaneously protect ourselves from the potential risks that occur in any economic environment. So this is a very deliberate balance between aggression and safety. It is not seeing how fast we can go.
I'm going fast again!
And we throw caution to the wind and we just simply wing it and hope for the best. We are constantly putting ourselves into a safer yet more accelerated position. Hopefully this helps you guys to some extent. If you want to learn more about home equity lines of credit and other debt weapons, consider subscribing to the channel. We've got unbelievable content on this channel, content I've not seen on any other resource here on YouTube or any other website for that matter. So make sure that you're a participant so you can get out there and beat those banks, turn the banks against each other. We're here to help you do it, guys. We look forward to seeing you on the next video. Thank you so much for checking this one out. Make it a great day today and take care. Alrighty, so I realize that some of you have not gotten one of the single most popular budgeting tools available, not to mention it's free, and that is called the Cash Flow Cruncher. So what I want to do today is walk you through the process of downloading your very own copy. It comes in the form of an Excel spreadsheet, so it's very easy to use and it's quick to navigate. So let's go ahead and walk through that process together. Go to cashflowcruncher.com, which will take you to the download page. Simply type your email address into the field to claim your free copy and go ahead and select the red button. Immediately it'll pull up the download button, which will open a new Cash Flow Cruncher spreadsheet. The first page it'll open is the Cash Flow Summary tab, which is a non-editable page. It's very important to understand that this opening tab will not require you to put any information into these fields. This actually imports the data from the other tabs below. Now, if you've ever used an Excel spreadsheet, you'll navigate the spreadsheet by going to individual pages down here. And it'll start with the revenue and assets page. On this page, you'll want to itemize each individual income that you bring into the household or the business. Now, it's always been my recommendation that you create an individual cash flow cruncher for your businesses, an individual cash flow cruncher for your real estate, and an individual cash flow cruncher for your household.